Hey everyone, welcome to this edition of the Macro Snapshot. Sorry I couldn't do one this morning. I had some personal stuff I had to attend to. So as I'm recording this, is Tuesday, June the 9th, 2026, recording this just as the market's closing at about 4 o'clock. So not like a full thing, just want to have a quick look at some of the markets and have some maybe some preliminary comments about tomorrow's BOC. Sort of interest rate decision and the CPI, which we're getting before Thursday's PPI. So obviously we had a pretty sharp continuation of the sell-off going into the morning this morning. And if you look here, let's say the Nasdaq futures, what we can see here is that, I mean, I don't know if we can look at this with a huge amount of sort of predictive power, but we did see that it bounced off the 50-day moving average. Maybe that was enough for the moment. I mean, if we break this down to the 4-hour chart, I mean, it could just be sort of a technical flush out here as well, because what I was signaling yesterday morning was to say that, you know, the bulls really had to push it above, you know, this Fibonacci zone. We sort of made it back here on the 4-hour chart just to the 50% retrace. And then, you know, if we want to do a Fibonacci sort of extended move just to see where we got to, we actually pushed it down, as I said, to the 50-day EMA on the dailies. And you can see here just this Fibonacci extension here. It kind of went down into one of those sort of pockets there as well. So again, I don't know if that was a specific level. I mean, I was looking at, again, going back to the dailies here. If you look at the ES, you know, watch. But the point is that the market wanted to have a bit of a sell-off. Why is this not changing? Hold on, let me just see if this is going back. But if we put it onto a shorter term sort of chart, you can see that we did get a pretty sharp sort of reversal, a V-shaped reversal, which is quite bullish across a lot of asset classes. So you see here around about sort of 1 p.m. here, we got a pretty sharp sort of reversal. Now, was that the bond auctions? No, it started happening before the bond auctions. Just on the bond auction, we had a three-year sort of sale today. Obviously, we have the 10-year and the 30-year coming up over the next couple of days. We got a small sort of a tail today, but it's just 0.3 basis points, so not a huge amount of you know, a lack of demand. And actually, there was quite a concession built into the 3-year market. You know, there was sort of talk that Trump was saying around the middle of the day, saying that because the I think it was the Black Hawk, or one of the US military helicopters, had indeed apparently been shot down by the Iranians, Trump came out and tweeted that there needed to be a response. But my reading of that, he said there needed to be a response. You know, are we in the realms here of political theater, basically saying, hey guys, I'm going to do a tit for tat response. This doesn't mean I don't want to deal. And in fact, the foreign minister of Iran came out relatively soon after Trump's initial tweet, basically saying that, you know, people should be careful, and if there were errors or whatever. And that just is just my sort of reading, and again, just my sort of gut feeling and experience is telling me that neither side at this point particularly wants to massively escalate. And maybe that's why the market got that sense as well. There was a bit of a push higher. Who knows? Maybe it was the technical bounce off the 50-day moving average, et cetera, et cetera. Maybe the dealers came in, the zero DTEs, who knows? But the point is here, there was a pretty nice bounce, and maybe that's it. So we saw that in the Nasdaq. We also saw that in the ES. We saw a nice bounce. We also saw it in the Russells. And then if we go into the sort of the subsectors, which everyone's keeping an eye on at the moment, we can see here, let's have a look at the equal weight. Kind of interesting to see how you can see that they're going into even the close pretty strong. So equal weight doing well. The Mag 7s, a nice sort of bounce, not as strong, but pretty good. Now, the all-important sort of semiconductors, again, nice V-shaped sort of bounce here, and going strongly up into the open. Let's have a look at software, you know, not as strong, but still pretty good. So all in all, you know, the thing is here is that the narrative is still, you know, relatively positive. We had a sort of a technical flush out. You know, we also saw in the Kospi, for example, had a flush out, but I believe that's also up. Let's just have a look at the Kospi over in Korea. I'm not sure if we're going to get those latest numbers here. You see there had a flush up, but already sort of pushing higher. So the point here is that there's still plenty of good news in terms of the AI narrative. The markets were very, very stretched. I talked about that last week. Personally, I think a lot of it at the moment, we have SpaceX probably coming on Friday. We have issuance from, as I've said many times, Alphabet issuing sort of stocks to the tune of about $80 billion. And I think the market was just kind of digesting that, at the end of the day, if you're talking 80, 100, 150 billion dollars, that money needs to come from somewhere. And I do believe that this was just a bit of a sort of a flush out on the US sort of tech space, because overall, there's still plenty of appetite for this narrative. And it seems that, the other thing as well, if we look at sort of, let's say, energy prices, you can see that crude oil on the front contract, has been grinding to the lower part of its range. Now, does this mean that crude oil is going to sort of collapse? I don't know. I think the market's still out on that. Now, what I want to draw your attention to, just while we're on crude oil, if you look here at the front contract, which is July, for sure it's come down, trading at about $88. But we're obviously a long way still above the pre-war levels. I mean, I don't need to tell anyone that. But what is interesting, just keep an eye here. I'm just going to flick through 3 months at a time. So this is the July contract. Now look here at September, look here at December, and then look here at March 27. So here's March 27. So my point being, just look at the relative value here. Now, obviously, the outright price is $77. But my point is that if we go out to March 27, you see that we're still pretty close almost to the highs. If we go, let's then go back in time closer to us, coming back towards us. This is December 26. September 26, and the front contract now is July 26. The point I'm trying to make is that the back of the curve is still essentially saying, we're not completely convinced that this whole Strait of Hormuz thing is going to be rapidly sort of organized and opened, and that supply will get back to pre-war levels very, very easily. My point being is, if you look at the back of the curve, it's still relatively strong, even compared to the front of the curve. And that is telling us, that is the market basically saying to us, hey, we're still a bit concerned about sort of oil supplies, let's say even like 6 or 9 months out from today. And the reason I think this is important is just because that would argue potentially for sort of sticky inflation. So energy-based sticky inflation sticking around, there's a bad pun, sticking around for a little bit and not immediately dropping like a stone, as Trump said. Now, for sure, I think if they were to reach a quick deal and the Strait of Hormuz were to be quote unquote opened, let's say within a week or 2 or 3 or 4, is that going to cause the overall curve to come down in oil? I think absolutely. But the problem is, at least what the market seems to be communicating to us, is that to have full sort of resumption of flow is going to happen. Absolutely, it's going to happen. But it's going to take, a month or 2 or 3 or 4, and therefore we're not going to just get a complete reversal. And what does that mean? That means that there's still another month or 2 or 3, even if we do get a deal, and of course we may not, but if we do get a deal, it's still going to mean another month or 2 or 3 of a relatively sort of elevated energy prices. And the longer we get that, that's going to sort of slowly, increasingly bleed into the core of inflation, not just the headline number of inflation. Remember, the Fed doesn't really care about, or doesn't care, cares less about headline energy and food, but the core, that's when all the whole supply chains and the cost of plastics and fertilizers and food and packaging and supply chains and transportation and logistics, all of this stuff sort of bleeds into the core, and that's what gets the Fed's attention. So this is going to be interesting to see how we go. Now, of course, we do get the CPI numbers tomorrow. And if we look at the CPI, I mean, just one thing, a couple of quick preliminary remarks. Keep in mind, it's going to be interesting what happens to Wash if the CPI is a bit elevated, and it is expected to be more elevated. Keep in mind that one of his core sort of thoughts was to say that, hey guys, with AI, artificial intelligence, we're going to get a huge sort of boom, a disinflationary boom from productivity. It's going to be productivity gains. But what is interesting, we saw the strong employment data last week. What happens if employment data actually continues to push higher and is stronger? That's not exactly disinflationary, and it's not exactly sort of chiming in with Walsh's sort of theory that, there's going to be sort of less jobs, so disinflationary and more productivity, et cetera, et cetera. I'm just trying to say, if we continue to get sort of strong employment numbers, doesn't that argue not for a disinflationary productivity boom, but maybe, let's just call it, a slightly stickier sort of wage price at a minimum. The other thing, if we continue to have strong employment data, doesn't that argue for the fact that maybe monetary policy is not very restrictive at all and is still too accommodative? And that would argue against any kinds of cuts. It could just be that Walsh says, maybe the best solution at the moment is certainly not to hike, but just to say, hey, no cut. So just an extended pause. If I were Walsh, and I'm not, but if I were Walsh, I think that's where I'd be sort of trying to sort of go with the committee. And it's just interesting while we're talking about Walsh, just reading something interesting that historically markets do test relatively soon into their term new Fed chairs. And you can just see if you're sort of interested, you can go back in time a little bit and look at, let's say, Greenspan, even Jerome Powell, Paul Volcker, Ben Bernanke, Arthur Burns, going back for the last 20, 30, 40 years. And basically, you can see here, this is courtesy of T.S. Lombard. Thank you for them. You can basically see that, pretty often, if there's any kind of tremor or problem in the market fairly early into the Fed's chairmanship, then the markets often push back and say to the Fed chair, "Hey, are you going to be sort of sort of strong and in the face of pressure, sort of hike or at least not cut, or are you going to be sort of a wimpy dove?" So just interesting, that sort of political thing, because markets definitely do like to test the new Fed chairs. Just while we've got some of the charts up as well, just keep in mind here, just looking at some of the inflation stuff, have a quick look at core CPI. You can just see here, just like the contributions here, the 6-month average. The point is here is that goods is continuing to rise up here. You see here, housing is has been going down, but starting to tick up a little bit. And core services, excluding housing, maybe down a little bit, but still relatively elevated. And probably more to the point, if we get up to this one here, these are the big numbers. If you look at core PCE, look at that starting to trend upwards again, and the actual PCE itself starting to go up. But keep in mind that the PCE is the most important one historically for the Fed. Tomorrow, we're not getting PCE, we're getting the CPI. And it's, I think, before we really take definitive conclusions, keep in mind that the day after tomorrow, so sort of Thursday, we will get the PPI, which is the producer price input. So tomorrow is consumer price input, but we also need the producer price input, because that is the one which actually inputs, determines has a lot more effect on the PCE, which is what the Fed looks at. So I think the market really will probably want to digest tomorrow, and then we'll pay a special attention to the PPI data on Thursday, because that'll give us a pretty good read then on what the PCE will be, which technically is the one which the Fed is the most sort of focused on. Just also, while we're just looking at the payrolls here, you can see the payroll, see the monthly change, we know is pretty strong here, 3-month average going up here. So the point here is that, the employment situation is very strong, and we know the Fed has 2 mandates, and therefore, as long as that employment mandate remains strong, it's difficult to argue that the economy needs to be boosted by cutting interest rates. And one could also argue that as long as the economy remains strong and employment in particular, it's not necessarily disinflationary. Anyway, so let's just have a quick look and see the numbers which we're expecting tomorrow. And again, I'll probably talk about this tomorrow morning in a bit more detail, but let's just refresh our memories and see what the market is expecting. The economic calendar tomorrow, where are we? Yeah, so just having a quick look at this here, you can see that basically what we're expecting for the core month over month, if I can actually find that, the core month over month here is expected for 0.3 month over month for the core. And then if you look at the year over year, up to 2.9%. So 2.9%, well above the Fed's target. And then if you look at the headline number, we're expecting 0.5 month over month. Now, a lot of that is expected, obviously, to be sort of oil prices and energy prices. So one could argue that, that's transitory. But what I was trying to say before, looking at the oil curve, is that, how transitory is this going to be? Because the oil curve is telling us that it's not expecting sort of a massive fall off at this point. We'll see. Now, look at this number 4.2 for the headline year over year number 4.2. Keep in mind, as we all know, the Fed's target is 2%. So, it's just, all I'm trying to say is that politically, we all understand that, this stuff is being caused by the war. But remember, the war was meant to be sort of a one and done in a week or two. Let's be honest, that's what Trump was thinking. And we're now about 100 days into that war. So the point is that, to use words like temporary and transitory are becoming a little less sort of authoritative, shall we say. And with a 4.2 handle, that's just not a good political optic for Walsh at his first meeting in a couple of weeks to be saying, oh, yeah, we should be cutting interest rates. So I think at a minimum, we'll be talking about we'll be talking about, just a pause. And keep in mind that is, I'm not saying anything radical here. If we just look at like the Fed here, you can see here what's expected. You can see the number of basis points. See on the left here, down here, the left of the chart here. You can see here just what the market is pricing in for the next meetings. It's just pricing in not much at all. And the first cut, no cuts, of course. But in terms of the first hike, the market's pricing in 28 basis points by December. So, 112% chance of a hike there, or of 25 basis point hike, so 28 basis points there. So the market is basically saying, hey, for the next, 6, 7 months, nothing's going to happen at all. So, no need to sort of panic tomorrow, in a sense. Because we're not expecting Wash to do anything in a couple of weeks. Okay, so just again looking at a couple of other markets, just have a quick look here as we close up. I also just want to look at something else. We saw the bonds, just having a quick look at the bonds today. Now, obviously, there was a little bit of so some of the headlines that Trump was going to attack and then not attack. But if we actually look at the yields, pretty choppy day. We look at the 2-year yield here. You can see here that it's sort of poked higher, but coming off its highs. Same thing here for the 10s, which is still over the 4.5 level, but it's finding it difficult to go above this sort of downward trend here. So on the way downwards here, if we look at the 30-year, sort of coming down a little bit today. So coming down just a little bit, after that very strong data on sort of Friday and the puke, maybe a bit of safe haven as the equity sold off today. So that's for the bonds. The other thing, which of course is interesting, is to look at gold. And let's have a look at gold. Pretty interesting what's happening. Obviously, with the strong US dollar, it continues to remain strong. The high nominal yields, the high real yields. And gold now, it's broken, pretty decisively below this very, very key 200-day moving average, the red one here. It's also broken below local highs. It attempted to rally a little bit, a bit of a pathetic rally. You'd have to call this a failed rally. This is very weak price action. So especially if we get, as is expected, relatively nothing comforting for the gold market or the bond market tomorrow. Now, we are expecting a hot number tomorrow, but if there's nothing comforting, which I doubt there will be, but you never know because one can always have surprises, we could see just a further push down. And the closer we get down here, the closest that recent low is looking like a target for gold. Now the question is, if we get inline data, will gold rally? Possibly a short relief rally. But the reality is that the fundamentals at the moment are pretty much set in stone just for the moment. Similar kind of situation here with silver. Silver also is now broken down, obviously below the fib levels, also below the 200-day moving average. That too is not looking great. As always, copper, a bit weak, but certainly the less dirty shirt, shall we say, the least dirty shirt in the metal space at the moment, and a little bit of choppy action, but kind of caught between the two. Probably not a good moment to be trading at just at the moment. BTC was very weak today. Look at this weak price action, just finding it very difficult to bounce. For sure, what BTC needs is, first of all, maybe some sort of momentum, some of the speculative froth to come out of some of these sort of memory and chip names and the AI sort of space. A lot of the momentum's gone out of it, but pretty weak price action. Let's just say that. Something else which I do want to look at, guys, just over in the energy space is US dollar. Sorry, in the FX space, US dollar. If you zoom out here a little bit, we can see that the US dollar it's towards the top of its range, and I've got it in this sort of nice little lilac colored box here, getting towards the top of its range. It broke out above where it had been at about 99.5 and got up to about 100 or so. So still looking pretty strong. And what's interesting about the US dollar, just watching the intraday price action, it's almost like nothing really at the moment can weaken it too much. And that makes sense just because the hawkish repricing of the Fed, so interest rates and yields are up. We have strong employment data, strong real economy data, and certainly you have pretty sort of elevated sort of energy prices in the US, is a strong energy producer of energy, and also a strong stock market. So, there's not really a huge amount of reasons to be selling the US dollar at the moment, especially compared to what's going on elsewhere. Where I do want to put a little bit of attention here is USD CAD, because we do have the Bank of Canada tomorrow. So let's just have a quick look here. And you can see here that if you look at the Bank of Canada, what you can see here, the Bank of Canada, USD CAD, you can see the US dollar has strengthened a lot. And then you can say, well, is it time to come off? So what's expected tomorrow? If we look at the Bank of Canada, First of all, let's just look at the sort of the pricing for that. And you can see here, again, in the middle here, you see that what the market is pricing for tomorrow's meeting, the 10th of June, is precisely nothing, just, half a basis point. So essentially just a 2% chance of a hike. But what is interesting is that the market by the end of the year, by December, is pricing in about 31 basis points of hikes, which of course equates to about 1.25 hikes. So the market is still saying, hey, the Bank of Canada is probably not going to do much for the next 2 or 3 meetings. And tomorrow it is expected a hold, but it is expected to hike still by the end of the year. And that's kind of interesting. I mean, is that justified? I mean, if we just go back and look a little bit, we can see, I just want to show you, well, I'll show you in a second, but the headline last time came in at 2.8%. So we're quite a long way from the US over the four handle. The headline inflation came in at 2.8%. Which was less than expected. Is that still more than the Bank of Canada's desired sort of range? Yes, but it's not like in a 3.5 or 4 handle. The other thing as well is that the job market, if you look at the first 4 months of the year, Canada lost about 112,000 jobs. Very, very bad. Now, the last job reading we got a couple of days ago, that was plus 87,000 for May. So that's positive. But the point is that the job market over the last, let's say, 3 or 4 months is weaker than the US, for example, and I guess we could say is sort of mixed. And then if you look at the GDP, the GDP is still not great. I mean, there's technically a technical recession. If you look at sort of a fourth quarter of 2025, it was -1%. -1%. Now, the net upcoming numbers are expected to be a bit better, but basically, you've got a GDP which is not great. You've got a lot of trade uncertainty. You've got the United States, Mexico, Canada trade agreement, USMCA, which is being negotiated. There's still stuff about tariffs. It's not great on the tariffs trade negotiation, a weakening GDP, sort of a slightly sketchy jobs number, and you still have an unemployment rate which is very high at 6.6%. And so what's kind of interesting is to say that, yes, USD CAD is pretty strong. Is it too strong? Does Canadian dollar need to strengthen a little bit? And is this sort of market pricing here, accurate? I would say, I don't know. I mean, does Tiff Macklem need to sound sort of hawkish tomorrow? Because they're not going to do anything. But I think he may come in and sound a little bit more circumspect, a little more dovish than the market is pricing here. Because I think 31 basis points by the end of the year, basically the same as the US. Actually, a little bit less than the US, which is pricing 40. What's the US price? Actually, more than the US. You see, the US is pricing 28 basis points here. Canada, according to the market's pricing 31, so more hawkish. And I think that might be just a little bit overdone, especially because I just want to finish off here, guys. If you look at sort of interest rate differentials, I mean, my point is the fundamentals here. So if you look at some of the interest rate differentials, if you look at the 2-year, which is a good proxy for FX, I mean, look here, this is the US 2-year, subtract the Canadian 2-year. And what we can see here is that looking at it, there's a differential still here of about 1.3% in favor of the US 2-year yield. So the point is that it makes fundamental sense here as this 2-year goes up that USD CAD should be strong, just because you get more bang for your buck, more interest for your US dollar compared to the Canadian dollar. So it's not as though the interest rate differentials would argue for a stronger Canadian dollar. So interesting to see what happens tomorrow. But as I say, I think the market is being a tad sort of hawkish because, as I say, there's a lot of uncertainty about the Canadian economy just at the moment. And the other thing as well, just before we finish, is that a lot of people say, yeah, but Canada is a major producer of crude oil. And that's true, and energy, and that's great. But remember that if it goes up too much, that also would start to potentially weigh on global economic activity, which for an open economy like Canada's is not necessarily a great thing. So there's a bit of a delicate tipping point here that if the price of oil goes up a lot, okay, maybe that's not, that's possibly a positive for the US, for the Canadian dollar. But as I say, the market soon tips into sort of worrying about a slowdown in global growth, which actually that safe haven flow would benefit the US dollar. Okay, guys, I'm going to leave it there. Just as I say, a bit of a catch up at the end of today, Tuesday, June the 9th. I'll be back tomorrow morning relatively early with a macro snapshot. I may repeat some of these things just about the CPI and the Bank of Canada decision, and we'll see what happens overnight and just see if there's any more headlines. Take care. Have a nice afternoon/evening, and I'll be back tomorrow with the macro snapshot from the macro shop. Thanks very much. Take care.